talk to Helen. Good morning, Helen.
Good morning, James. How are you today?
Good, thank you. Very good.
Great.
So you're going to tell us a bit about the private equity market, which should be quite interesting. Specifically, shrinking public markets, expanding private markets. So do you want to just introduce the topic for us, please?
Yes, of course. And would you like me to say anything about Pantheon International to start with, James? I know you had a...
yeah, by all means, but just to do sort of 5 minutes on what fund is and what you're trying to do, that'd be really helpful.
Great. So maybe kick off with that, and then we'll get into this latest study that we've just published, actually. So it's on our website. First of all, thank you very much for kind remarks about Pantheon Infrastructure, or PINT. So we were very, very pleased with the appetite for that, and quite excited now to have a second investment trust in the Pantheon stable. But to come back to Pantheon International, or PIP, it's a FTSE 250 investment trust. It's been listed for over 33 years. The market cap is around £1.7 billion. And essentially what it does is it provides investors with the go-to FTSE vehicle for access to exciting, growing private companies all over the world. And it's about 50% invested in the US, about 30% in Europe, and the rest Asia and sort of global assets. So it's a very actively managed trust as well, has an independent board of directors, very strong ESG credentials, and long-term performance, over that sort of more than 30-year period has been extremely good. So the NAV per share growth, 12.2% net since inception per annum. Over the past year, it's been close to 32%. And the share price performance has also been good since inception, 11.6%, and over the past year, sort of on a rolling 12-month basis, it's up 44%. I think what's interesting is to look at the outperformance over the FTSE and over the MSCI. So over the long term, 400 basis points over the FTSE and 300 basis points over the MSCI on a sort of compound basis. So, so essentially, the PIP makes the private public, and we'll talk about all the reasons why we think private equity continues to be a really exciting asset class, and why PIP is a great way to access it, actually.
Great. I should mention this point. I am a very happy shareholder of Pantheon.
Good.
So yeah, and it's been a very good performer within my portfolio. So
great.
Good.
as am I. I'm also a big shareholder, and actually the board all hold very sizable shareholdings. So they definitely hold us to account, James. But maybe turning now to the research that we've just published, and you can find that on the website. So I don't know whether people might remember, about 4 years ago, we published an analysis of the long-term decline in the number of publicly listed companies worldwide. And we found that there was a collapse of around 50% in developed markets between 1996 and 2016, a collapse in the number of publicly quoted companies. And that means that the remaining companies left on the stock exchange tend to be older, larger, slower growing. So we decided to update this analysis, and the updated analysis basically shows that the trend has continued. So some of these headlines you can see on the page are a little bit in reaction to that study, and other people as well have done sort of similar studies. So I think it's a very well observed phenomenon that while public markets clearly have grown, the number of public stocks has actually shrunk. And in the meantime, yeah, private markets, assets under management, has been growing really steadily. So this is all private markets, not just private equity. So it includes infrastructure, private debt, natural resources, and real estate. But if we just take private equity here, you can see that in 2020, over $5 trillion, and that's a doubling since 2018. And we're expecting that to pretty much double again by 2025. We're expecting probably around $9.5 trillion in private equity AUM by 2025. Why is that? Well, investors are after returns, and private equity has been shown to outperform, and I'll talk a little bit about that as well.
I suppose we should point out that this is just the money that's inside funds that are investing into private stocks. So obviously private companies it's a far, far bigger market than that.
Yeah, that's a very good comment, James. Yes, this is just private market-backed companies. So clearly, it's an even bigger universe out there. But yeah, this is sort of the whole of the private markets universe. So private markets have been growing really fast, and you can see this. This is the 10-year growth rate. So private markets 12%, and that contrasts with global equities, which has risen 8% compounded over the same period. And you can see on the right-hand side actually that with the growth, private markets now account for just under 5% of financial markets. So it's grown, but it's still a small slice of the overall sort of investment universe. So people always talk about private equity, it's huge and all of that. Well, we think it's huge because we work in it every day. But as a slice of the investable universe, it's still quite small. And if you just take private equity as a percentage of GDP in the most sophisticated, deepest market in the world, which is the US, it's still less than 2% of GDP. So we think there's a great deal of room to grow. The other thing I would say is that while public markets, clearly have grown enormously over the last period of time as well, more money is actually being invested passively, and that has huge implications. While private markets, by definition, are actively managed.
Yeah, I think that's a big thing, definitely, because as the markets shrink and more of it is in passive investment, it's become more and more inefficient.
Yeah, and probably volatility actually increases as well. And actually, James, I saw a really interesting report this morning. I haven't had a chance to go through it in detail, but it was Bloomberg Intelligence saying that they expect private equity returns to top all other asset classes over the next 5 years. So, as we all know, public market returns have been very strong over the last 5 years, but they're predicted to sink to probably 4 to 7% over the next 5 years, while private equity is still expected to show double-digit growth. And one of the reasons for that, and I'll go into a little bit later, is that private equity is actively managed and actually does extremely well in challenging market conditions. Actually, private equity likes dislocation and change.
So this chart we've got here is just showing just how many deals have been going on. Is this a reflection of how much money is being raised by the funds?
So this is actually almost like the demand side of it. What I showed earlier was the supply of capital. So that's the assets under management. This is really sort of the demand for capital. So this is the investment activity. This is in billions of dollars. And it's money that's actually going into the ground. And then you've got the number at the top of the charts here. And what it's shown actually is that private equity almost didn't miss a beat with the pandemic last year. So while investment activity, if you add together buyout and venture, was slightly behind the peak year, which was 2018, it was still ahead of 2019. And the year-to-date number is actually very large indeed. And all the indications are that this is going to be a massive record this year. So there's a lot of money being invested actually in private companies this year.
Yeah. But here we go. So this is the number of companies that are in these funds.
Yeah, so this chart shows what I was referring to earlier. So this is the chart that we updated. We had shown it to 2016 and now we've extended it out to 2020. So what it's showing is that decline continues. So the percentage decline per annum in public, the number of public companies is just over 2%, 2.2%. And the number of private companies, private equity-backed companies in the US and Europe, so this doesn't count Asia, has gone up by 5.7% on a compound basis. So I think that chart is actually quite stark. And what it's showing is that public markets are shrinking in terms of the number of opportunities, and private markets are increasing and providing more opportunities for investment.
If we looked at somewhere like Asia, would the pattern be different?
I think the overall trend is similar. I mean, actually on the next slide, we've got a whole series of different countries. I don't actually have any Asian countries, so we could dig out those numbers. And you can see on the right-hand side, sort of the peak to trough declines, range from sort of 75% in the Netherlands to the UK, actually, which has had the lowest sort of shrinkage, 36%. And I mean, the chart on the left, quite difficult to read actually, because there was an increase in the number of public companies until about sort of 96. And then after that, you can see the US chart at the bottom. Difficult to tell actually with the scale, but there's been a halving of the number of companies.
Well, yeah.
And what's happening, James, is that companies are actually spending longer as private companies. So if you go to the next chart, you'll see that we've just taken here 3 companies that started out as private companies, venture capital, private equity backed, and then became public companies. And you can see that, you know, way back in 1994, Amazon spent 3 years as a private company before it IPO'd. But then if we fast forward to Facebook, it spent 8 years as a private company. So the number of years that companies spend as a private company and the growth that happens during that period of time has been increasing, and that's the same in Europe as well. So companies are staying private for longer, and you might ask why. Well, first of all, they can get the capital they need to grow in private markets. They don't have to IPO these days. 20 years ago, to raise the sort of money that Amazon raised, you had to go public. Now, you don't need to do that. And then there's all sorts of other advantages that a private equity backer can give a company that you can't find in public markets. So they get support, they get help, they get hands-on expertise. I was talking to one of my managers yesterday, and they've got something like 100 operating partners that they can just deploy in their portfolio companies to help them improve their supply chain management, their digital marketing, capital markets expertise. So the companies actually aren't just after capital, they're actually also after this expertise as well, which I think is quite interesting and sort of explains that.
This slide's interesting because it just shows the breadth of sectors that you're looking at.
Yeah, exactly. And PIP is very much weighted towards information technology and healthcare. So between the two of them, about 50% of the portfolio, the NAV, is in information technology and healthcare. And even in some of the other sectors, like consumer or financials or industrials, you've got a very high level of sort of digital consumer or digital fintech, for example. So the portfolio is very much biased towards sort of digitally enabled businesses. And this is what you can see on the slide here, because we think about information technology as not just a vertical, where you're investing in software firms like Visma, which is in our portfolio, or Recorded Future, or Datadog, actually, which is now IPO, that was also in our portfolio. But also it's a horizontal. So, digitization is transforming every other sector. So whether it's consumer, with e-commerce and online marketplaces, or whether it's healthcare, sort of digital healthcare. For example, we got a company in the portfolio called 4Ways, which provides remote radiology services. So it's healthcare, but it's using a digital backbone. And then, of course, business and financial services. So we don't really have, in fact, we don't have sort of traditional financial services in the portfolio, but we do have digital banks, we have digital payments, we have insurtech. So, for example, Nexi is a big digital payments platform in Europe, started as a spin-out of the digital and card services of an Italian bank, and then bought up a number of other platforms, and it's now a leading European digital payments platform. So it's affecting every other sector, and that's what's really increasing the number of opportunities that we can invest in. And it's exciting because these dislocations are providing huge opportunities for growth. And in fact, if you look at the revenue growth and the EBITDA growth in our portfolio, the revenue growth was around 12% last year, and the EBITDA growth was around 20%. So, really fast-growing businesses inside the portfolio.
So, if you think about sort of the old-fashioned view of private equity, which is to buy sort of solid cash-generative companies, leverage them, and then profit as the business repaid the debt that you'd taken out. Is that still a factor of the market? Is it still featuring the market, or is more and more of it going the way that we were talking about here in terms of building businesses?
Yeah, I mean, there are still some of those deals around, but I think Bain Capital did a study earlier this year, and they worked out that 30% of buyouts are actually in technology, in information technology. So the whole market has really shifted more into these high growth sectors. You can still find funds that do some of the older type deals, but PIP is not focusing on those. I mean, we focus on small and mid-market buyouts, which tend to be these faster growing businesses, and growth equity, which does what it says on the tin. So you will still find some of those things around, but I think that the whole industry has moved much more into these sort of higher growth sectors. So this old view, of private equity investing in, pub chains or restaurant chains or department stores, that is kind of 20 years out of date, really.
But you don't do venture stuff, do you?
We do venture, yeah.
Oh, okay.
Yeah, we do venture. When we do co-investments, we tend to do co-investments either in buyouts or growth equity, because venture is a lot more volatile. But what we do have in the portfolio in the PIP portfolio is exposure to some of the best venture funds in the world. And these venture funds are almost impossible to get into these days. Even big institutional investors find it very hard. They're essentially closed to new investors. So we offer that actually as part of the package, really, for our investors in PIP.
There's a question popped up here actually already. I'm talking about the sort of general exposure to tech across the fund. Is this let's read the question properly. So pretty much all PE funds have significant exposures to tech now, which did well during the pandemic, but is there still concentration risk, do you think?
Well, we were actually investing in information technology before the pandemic because we recognised it as a secular trend that wasn't going to go away. So, for example, we invested in Allegro, which is the Amazon of Poland. So it's an e-commerce marketplace in Poland, and we invested in that business in 2017 because we recognised that more and more people were going online. Now, clearly, that's benefited hugely during the pandemic, as have many other companies in the portfolio. But we think these trends are really fundamental, and while they might have been accelerated by the pandemic, they're not going away. I mean, same thing with healthcare. We've been investing behind long-term healthcare trends for a long time before the pandemic. So aging demographics, prevalence of proliferation actually of rich countries' diseases. So unpleasant things like horrible diseases and obesity and things like that. Unfortunately on the rise, and companies in the portfolio that are developing drugs and treatments for those types of diseases. So I think actually private equity is all about trying to recognize these long-term trends and then finding from the bottom up, the companies that are really best placed to address those trends. So, the third trend is sustainability, and that was in place long before all the current discussion because of COP26. So we've got companies in the portfolio that have been investing in things like filtering technology or metering, energy metering. So it's not renewables, but it's sort of the technology that goes around things that help sustainability. And that's not going away either in the future.
What sort of sectors just don't feature in your portfolio that are in the listed markets?
So real estate, so nothing to do with real estate, property, really old economy, so basic industrial businesses. There's not much of that in the portfolio. We used to have energy. Our energy exposure's gone from, it was over 8%, it's now around 4%, and that's declining. So there is a weighting towards these higher growth sectors that are really trying to key into these long-term trends.
Is there any exposure to infrastructure type investments within the Pantheon International portfolio?
No. So the infrastructure will all go into Pantheon Infrastructure. It's got a different return profile. As you highlighted at the beginning, James, it's more sort of 8 to 10%, and we're looking for a much higher return profile in the private equity portfolio. And of course, infrastructure is yielding, whereas private equity is not.
Yeah, exactly. So that does make a difference. There's a sort of summary side here, but a couple of questions we should answer. ESG, how does that kind of factor into what you do?
So it's fundamental. We were one of the first two signatories, private equity signatories to the UNPRI back in 2007. So we've embedded it into our investment processes. So whether it's due diligence or monitoring, for well over 10 years now, we were really one of the pioneers, and we helped sort of spread the word. So with private equity managers, many of whom didn't kind of get it to start with and didn't have ESG policies. Now I would say that almost every manager in our portfolio has has a comprehensive ESG policy and is getting much better at the reporting side of it. But it's a challenge because there's no standardization, and it's really difficult to be able to aggregate the ESG data that comes out of our portfolio. However, we think that is something, we're not giving up on that, and we continue to push it. Every time we do a co-investment, we do a deep dive, obviously into all sort of the ESG factors, but it doesn't stop with the investment. We then monitor on an ongoing basis. We use an artificial intelligence tool which picks up mentions in social media and physical media of any E, S or G incidents that might occur in our portfolio anywhere in the world. And then we can follow up on the incidents and take action. So it's taken very seriously at Pantheon, and it's just embedded in everything that we do.
I mean, obviously, when you're talking about listed markets, it's down to shareholders to try and badger management to do the right thing. But I suppose at the end of the day, with the private sector, you've got almost complete control over what's going on, haven't you?
You have, and that's a really good point, James. So in most of these businesses, the private equity manager controls the business. So they have a majority stake in the business, they have the control of the board of directors, and it's a really short chain of command. So, and they can take action, and they can act on internal information. They're not worried about, they don't have the same issues that public markets have. So they can take action really quickly. And, we saw that actually in the pandemic. So private equity managers were on the case incredibly quickly with their portfolio companies. And that, I think, is why one of the reasons why private markets actually suffered very little decline in terms of NAV last year, and why they sprung back so quickly, because private equity managers took action very early on, and they helped the companies with supply chain issues at the beginning. They helped them with health issues and safety issues. They helped them with demand. A lot of the companies had to pivot to digital marketing because they couldn't sell physically, and all of that expertise was supplied by the private equity managers.
Do you look at monitor the carbon emissions of the portfolio? Is that something you have to do?
We are working on that, James, but as I said earlier, it's extremely hard because of the lack of standardization. So we do get reports from our managers, but not from all of them, and not in the same format. So there are a number of initiatives going on at the moment in the private equity industry to try and move towards more standardization of reporting so that we can report on an aggregated basis, because at the moment we can't do that.
Okay, thank you. A couple of things that you mentioned what happened last year. Obviously, we did see discounts spike out again, which is kind of frustrating. Why do you think it is that private equity funds trade on discount?
It's very frustrating, and it's somewhat baffling, James. And you're right, the discounts widened, but they actually came in really quickly. So they didn't stay at those wide discounts for a long period of time. But we are somewhat baffled because we believe very much in the value in the portfolio. We track our exits and we measure the cash, which doesn't lie, against the last full valuation of each portfolio company. And on average, our average uplift on exit is 26%. That's what it was in the last 12 months. And that's been very steady over a long period of time. So there's embedded value in the portfolio. So people that worry about value in private equity vehicles, seem to be discounting that. I think it's a perception issue. And I think people are still a little bit stuck in the past. And they still think that private equity invests in these sort of older industrial-based companies, or the older sort of physical companies, where, as you can see from just the microcosm, which is PIP, you can see that nothing could be further from the truth. So I think there's a lot of education to be done in the market, and hopefully the industry associations, events like this will help to get the word out there a little bit more.
Question here: how do you differentiate yourself from Harbourfest, if you feel the need to at all?
Yeah, we're quite different actually, because at Pantheon International, we invest directly into the co-investments, into the primary funds as well. So we build up the portfolio really from the ground up, and that's given us quite a bit of flexibility over time to shape the portfolio. So, for example, over the last 5 years, we have increased the level of co-investments in the portfolio. So we're now at around a third of the portfolios in co-investments, around a third in secondaries, and a third in primary funds. So it's a very different way of managing the portfolio, I would say. In other ways, we're similar. We're both global vehicles. We're 50% US, 30% Europe. We've got a bit of a bias to small and mid-market and growth, and we've got about 4% in sort of pure venture, which is the most sort of volatile part of the the entire spectrum. I think HVP's probably got a little bit more than that, but it's fundamentally the way that the portfolio is built. We're more of a direct investor. And actually, if you look through the portfolio by NAV, 46% of PIP's NAV is actually invested in single assets, so either co-investments or single asset secondaries, and 54% is in funds, so direct holdings in funds. So it's a different makeup to the portfolio.
Okay, thank you. As the private market grows at the expense of the public one, does that actually mean some of your sort of opportunity actually disappears? So does it become, I'm just trying to phrase this question. So basically the question is, as more money goes into the private sector, does that mean that Pantheon kind of loses its edge?
No, I don't think so. I mean, our platform just sort of continues to grow, and has done. Pantheon's been around now for 40 years and PIP for 33 years. So we just see an expansion of the number of opportunities. We only have a very small percentage of the portfolio that exits in IPOs. It's around, I think from memory, it's around about 10%. Most of our exits are to strategic and trade buyers, and then they're often to financial buyers, so other private equity funds. And because of the fact that we're focusing on small and mid-market buyouts, and often these companies are getting institutional capital, private equity capital, for the first time, and they get professionalized, and then they get sold on to a bigger private equity fund. So it sort of feeds the whole sort of ecosystem. But no, we're not worried about that. I mean, I think you can see as a percentage of the entire investable universe as well, private equity is still a very small slice.
One reason that's sort of cited for why things trade at discounts is because of the infrequency of the NAVs. Is there anything that could change on that front?
Yeah, it's hard, isn't it? Because it's not just infrequent, but it's also lagging, and I think that causes some concern for people. But our valuations are based upon the last available valuations that we get from the private equity managers themselves, and they value usually every quarter. There are some managers that only value twice a year, believe it or not. So we're dependent really on the private equity managers themselves, because they supply the valuations. So I don't think we would go out and then try and sort of second guess the managers in terms of the values. But what it means is there's always this little lag, sort of a few month lag actually. And because of the fact that private equity is always sort of building value, that means I think that there's always a bit of an inherent discount actually built in as well, which again is probably why when we exit at a value which is ahead of the last sort of official valuation.
Yeah, exactly. And I do think actually these things should trade around asset value, which should make more sense to me. Going back to sort of the topic, why do things need to IPO at all now, given that there's an opportunity to raise more capital from private equity when it's needed?
Well, I think that there are certain businesses, that are very well suited for public markets, and it is an exit route for managers. I mentioned Allegro, which was our Polish version of Amazon. I mean, that's a huge brand name in Poland. I think it's more recognizable than Pepsi-Cola or Coca-Cola. And it IPO'd there on the Warsaw Stock Exchange. So clearly that's a very well-known brand. I think there's quite a lot of retail interest in that stock. So that was probably a very good type of company to IPO. It's probably better to talk about companies that probably shouldn't IPO. If you've got a company that's still going to have, quite a lot of growth, where there could be setbacks along the way, or you might need to invest. It's a complex story. I'm not sure that public markets always recognise the complexity of the story and give sort of the benefit of the doubt to the company. So I do think there are some companies that should IPO, and some companies that probably should stay in private hands.
If you get sort of situation where it's much more normal for people to own these private companies through listed vehicles like Pantheon, then there's no real reason why you should need to IPO, is there? You'd be accessing the same investors through your funds, wouldn't you?
I suppose so, yes. And actually, I suppose you get a broader slice of private companies. I'm trying to get my head around that one, James. But, with PIP and the other listed vehicles, I mean, the great advantage, of course, is that you've got a diversified portfolio, so you're not dependent on one particular stock kind of knocking the lights out. So I think mostly it's for shareholders to be able to access that phenomenal growth. As I put in one of the slides, the pre-IPO market is like the IPO market of the past. So now, all the growth is happening before the IPO. So if investors want to access that growth, they need to be in private equity. And the listed vehicles are a very good way for shareholders, for investors to get access to that sort of phenomenal growth before the IPO.
I mean, reasonably, Pantheon could be a lot bigger than it is. Is there a way that you can expand the fund, do you think?
Well, while we're still trading at a discount, it's a bit of a challenge. I mean, we are doing a lot more marketing these days, social media. We actually just did a 10-to-1 stock split sort of earlier in November, because the stock was sort of up at something like 31 pounds. So we did 10-to-1, and that we think will make the shares a bit more accessible to people that might want to put it into their ISAs or their SIPs. So it sort of democratizes things even further. But yes, no, we think that PIP could be a great deal bigger. Overall, Pantheon manages about $71 billion across the world, and most of that capital is from institutional investors. And we've got this vehicle which is really ideal for retail and high net worth investors to get a slice of what the institutions are getting through these more traditional sort of fund structures, which are actually quite difficult to manage. Whereas within PIP we do all the complexity for the shareholder, management of all the cash, the calls, distributions, reporting, and all of that. So we think it could be a lot bigger than it is today.
Yeah, exactly. And one thing that's always sort of levied about this sector is the fees. So as you've got more now in co-invests than you used to, does that mean that the fees are actually lower than they used to be?
Well, it certainly helps with the overall fee burden, but and Pantheon's fee hasn't changed over the years, and we actually think we provide very good value for money. But when you look through, because we are required to report both the look-through management fees and the look-through carried interest that's charged on the primary funds and the secondary funds as well, we have to look through all the way to that lowest level. And the problem there is when you've got a really good year where you've had absolutely terrific NAV growth and great performance in the underlying funds, you're then reporting higher carried interest. So it's difficult to pick your way through it, because yes, by doing more co-investment, we will avoid having to pay fees and carried interest. But on the primary part of the portfolio, I mentioned some of those absolutely fantastic venture funds. If they, knock it out of the park and produce, and some of them have produced funds which sort of, 5 times cost, 6 times cost, then we have to pay the carried interest on that. So, and all that gets, reported in the KID. So it's a bit counterintuitive actually, because clearly the returns that we're reporting are net of all of that, but we still have to show this sort of look through at the underlying fund manager level.
Yeah, exactly. There's an interesting question here about why not hang on to things after they list? If you think it's a good company, is there a case for maintaining exposure to it on the listed market?
We tend to sell down at the same time as the private equity managers. So when we do a co-investment, and I mentioned Allegro, a few times, that was a co-investment alongside one of our Polish managers. The agreement is we go in on the same terms and conditions as the manager directly into the company, and we also sell at the same time and on the same terms and conditions. And in general, private equity managers don't like holding listed stock. They prefer to sell, obviously, in a controlled and sensible way, so they don't damage the way that the share price performs after the IPO. So it's a sort of a controlled exit. I mean, part of that, if you think about it as well, is fees, because the private equity managers are being paid a fee, and if the stock is now publicly quoted, it probably doesn't make sense to be charging that sort of a fee on the the remaining NAV. So, but I think more than that, private equity managers are expert in managing private companies. Managing or being involved in a public company is quite different. We said earlier that private equity managers tend to have very large stakes in their underlying portfolio companies. They're on the board of directors. Once the company is public, they can't do that. So they exit the board of directors. They have a much smaller stake. So it's not really the same. It's not the same sort of activity, I would say.
I think one of the attractions of Pantheon must be that it's an evergreen fund. So especially for things like co-investments. Do you think the sort of normal structure of sort of 7-year life funds still makes sense?
Yeah, that's a great point, because one of the advantages of PIP is that it can hold assets for longer. And actually, we had a big exit last year, one of our companies called Zenimax, which is a developer of games, and it started out on sort of consoles and then it migrated to mobile. We ended up holding that company in the portfolio for 14 years. And it was a tremendous exit. It was a very good rate of return. And it was sold to Microsoft. So it's, it's one of these cases where a strategic buyer, liked the business and came in and bought it. But we held that company for 14 years. And that's the way that we maximize value in that company. So I think there is something to be said for having these, these longer life vehicles. Now, the managers will argue that having a 10-year fund life, concentrates their focus. The institutional investors, want their money back. They don't want to have it sitting there for sort of 20 years. But I do think it's one of the advantages of PIP that we can hold on to these companies for a bit longer.
Cool. Thank you. Actually, that's what poses this question. So what's the sort of turnover on the portfolio?
Turnover. So the average life in the portfolio is about 5 years. That's the average maturity, and that's come down. I mentioned that we're an active manager, and we've been doing a number of things to the portfolio over the last 5 or 6 years. So rejuvenating it by doing things like doing co-investment. And 6 years ago, the average life in the portfolio was actually 8 years. So we've actually rejuvenated the portfolio. So I think that kind of tells you how often things will turn over. In terms of the managers that we work with, from one fund to the next, there's a re-up rate of around sort of 60-70%. So every time a manager comes back to the market, if it's in PIP's roadmap, we'll conduct due diligence, and in 60-70% of cases, we will re-up with that manager.
Oh, that's interesting stuff. I I think we'll probably wrap it up there if that's all right. But I do think it's an interesting study. So it's available on your website, is that right?
Yes, yes, it is, and I think it's well worth a look. There's lots of other stuff on our website as well. There's all sorts of case studies. You know, we talked about ESG earlier. There's quite a lot about ESG. There's some ESG case studies. There's quite a lot of company case studies in general. And there's a very interesting interview with two of our directors, John Burgess and John Singer, who are both big shareholders actually in PIP. And there's a dialogue about why they think private equity is interesting and an interesting way to invest in companies, and why they joined the board of PIP. So that's worth a look, actually.
Good. Thank you very much for that, Helen. I think it's a very interesting topic. So I recommend everybody to go and have a look at the website. And obviously, as I say, I'm a very happy shareholder. So keep up the good work.
Thank you very much, James.
Cool. Thank you. So we'll be back next week as usual, talking to Baillie Gifford UK Growth. But in the meantime, next week we've got our ESG webinars. So those are happening on the 16th, 17th and 18th of November. And we've got a whole spread of companies. As you see, that list has grown from last time I showed it to you. The whole spread of companies presenting. Lots of interesting topics. Obviously a bit about renewable energy and things, but a whole range of other stuff as well, including like social housing and some aspects of corporate governance as well that I think are probably going to be interesting to hear about. So I definitely recommend those to you. And if you haven't signed up, please do so on the website. We'll be playing on. So on the 26th of November, Jane is going to be talking to David Cornell of India Capital Growth. And then we have got people lined up for the 3rd and 10th of December. It's just a question of which order they're going to happen in. So they will appear. And then we think we're probably going to be taking a break on the 17th through to 7th of January. But we'll be back then. And Andrew Hattie and I will be doing a roundup of 2021. So have a good week, everybody. And I shall see you next Friday. But before that, obviously, hopefully we'll see you at the ESG webinars. Thanks very much.